Very pleased to welcome back to the show Martin Armstrong. As I've said regularly, if there was one person I was going to talk to about the world of economics and finance, it would be Marty. I have a great privilege to talk to a lot of talented people, but I've known Marty's work for over 35 years, and some shocking levels of prediction and forecasts that have come to fruition on time, on date. So who better to ask in this kind of environment, Martin Armstrong. Marty, thanks for taking time with us.
Oh, it's always a pleasure, Mike.
Well, let's start with one out of left field for you. I'm going to ask you about gold. Don't worry, everybody. I'm going to get to stocks with Marty. I'm going to get to the U.S. dollar. But I think one of the most fascinating things about Marty is that he's developed such a sophisticated way of modeling right through artificial intelligence that, Marty, you know, when I tell people that you use a model and you're not offering your opinions, it always confuses them. They're so used to the political world where people are just throwing opinions without any background methodology or modeling, that kind of stuff, but not yourself when it comes to these things. So just give me a quick summation of the difference between opinion and using a model like you do.
Well, the problem with opinion is that it can only be a reflection of to the extent you have experience. So if you have no experience beyond a little world, you don't really understand what's going on. And so it's usually the major impacts that alter everything are usually external. This is why our politicians are, really totally lost, because they stand up and say, well, all right, fine, vote for me, and I'm going to, like Hillary saying, I'm going to invest in the middle class. It's absolutely impossible, okay? You cannot change the direction of the world economy, simply yourself within your own country. We're all connected. So until they start understanding that if the world is in a deflationary mode, you can't simply reverse that. It's a psychological issue.
It's interesting. We didn't talk about any of this in preparation. We didn't have any conversation, but we've just chatted about that. Think about this, everybody. We just had a week where they've said that the Bank of Canada has now revised downward their forecast for Canadian economic growth to 1.1%. This is in spite of the deficit spending, record low rates, the loonies decline. What Marty's pointed out is exactly why. We don't control oil prices. There's too many other variables, and all the political talk about we're going to do this and we're going to do that. You just check it out. It doesn't work out. But speaking of politics, Marty, I want to come back to the U.S. election for a second. It's almost a boring topic at this point when it's been going on so long and so much coverage. But, if we talk about the impact on the economy and on the markets of the U.S. election, it's obviously overblown, but does it make any difference who wins in terms of the financial markets and the ultimate direction of society?
Well, from a long-term perspective, no. I mean, we are basically just heading down into 2020, and that's it. The U.S. has been the only economy holding up the world, and the growth rate is just minimal. I mean, it's really just minimal, but that's effectively what's happening because things are bad everywhere else. You have, people from China, they've been buying the highest priced real estate in the United States. You have Europeans sending money over here. Nobody trusts their government. So effectively, what's happened is that the dollar has become the de facto world currency. And the United States doesn't like this. There's actually, arguments going on in Washington that, how to make the U.S. dollar not the reserve currency. Because you hear, Yellen keeps saying, look, we have to normalize interest rates. Why is she saying that? Because all the pension funds are going bust. They need, most of these pension funds were based upon they needed 8% annually. They are losing money left and right. You have, a classic example in the debate. Hillary said, her policy, she's going to raise taxes on the rich to cover, Social Security. I don't care if you triple the taxes on the rich. Social Security, the system is absolutely broke. And no matter how much you raise the taxes, you cannot fix it. It's structurally wrong. And so when you take, the Social Security system, for example, in the U.S., 100% is only allowed to be invested in government bonds. Then you take interest rates, we're going to lower them to negative or virtually zero to help the banks. Well, then you wipe out the Social Security system. I mean, these people don't understand how everything is connected. So when Yellen keeps saying we have to normalize interest rates, who argues against her? It's the IMF saying, gee, if you do that, then emerging markets are going to go bankrupt. So what's happened is we've lost domestic policy objectives because of international. And this is reflecting what I'm saying, that politicians can't do anything. They just can't. So if the Fed raises interest rates, you're going to have all the emerging markets go bust. They were borrowing in dollars. So you start raising interest rates, they can't afford it. Commodities are down, they go bust. So you start having more sovereign defaults all over the place. Greece just announced on Friday they can't pay.
Mm-hmm. Well, that actually, you're leading in beautifully, and as I say, I'm going to get to the specifics about gold and the stocks and interest rates, that kind of stuff. But you've brought this question in perfectly. Your model predicted very clearly and accurately the rise in civil violence. We've seen it around the world. One of the things that's overlooked in the U.S. election is the things that's happened in Baltimore, the things that happened in Ferguson, Missouri, that kind of stuff. We're seeing a rise of that throughout the world, though. Then you throw in the sovereign debt crisis, which you just alluded to, that Greece has now said after bailout or whatever, they can't afford to pay at this point. And you get this sort of demise, this anti-political establishment movement at the same time. And I'm sort of shaking my head and saying, this is starting to create the perfect storm.
Yes, I mean, our computer on politics has been very amazing. I mean, it's actually never been wrong. It predicted that the Democrats should have won in 2000, which would have been Gore. All right, of course, the court gave it to Bush. When the net sum was done, it showed, yes, okay, fine. When they finally did count all the votes, the Democrats did win. But, say la vie, the court gave it to them. Brit exit, and you're asking about opinion versus models. I was very skeptical, and I said, look, I'm not so sure the computer says Brit exit's going to win. But all the press was lobbying against it. You had every head of state going in there. You had Obama flying over and saying, gee, if you don't give up your sovereignty, you're going to be at the end of at the queue. And it just really got everybody so angry. They went out, and the computer was right. It would have the biggest turnout, and they lost. So it's actually showing the same thing here. And people interpret. This is not something that Trump is a better person or something like that. This is really a global uprising that's happening everywhere. And in France, you have Holland, the president there. His polls are below 10%. You have Merkel, head of Germany. All right, the CDU has lost the last three elections. And so when it finally gets to the level where she's going to be elected, nobody wants her because of all the refugee crisis. So this is a global problem, and politicians have basically screwed everybody for so long, and we can't take it anymore.
Well, and as I say, it leads to the big question about the model and what it's saying now about the U.S. election. Because it accurately predicted, again, at the World Outlook Conference, was very accurate over 3 years ago. You very clearly stated we're going to see the rise of third-party politics in 2016. Well, that's certainly Donald Trump. He's completely rejected by the Republican establishment. He's a de facto third-party candidate, but running under the Republican banner. So the model, again, accurately predicted this rise of third-party politics. I'm just wondering what it says now.
Well, it hasn't changed. It basically says, kind of like the Brit exit, it says Trump should win. Out of 4 models, 3 basically pick Trump. So what's happening? I mean, they're doing exactly the same thing here as they did in Britain. Virtually 99% of all the newspapers endorse Hillary, even though that they're the ones that maybe, like the New York Times, exposed her with the emails, all the corruption, whatever. So why are they all doing Hillary? Just all you have to do is look at Trump's ethical reforms. What has he done? He stood up and said he wants basically term limits on Congress. 2 years, that's out. You're gone. That's why all the elite Republicans, no way are they going to support him. They're going to support Hillary because it's their personal jobs at stake. All right. They're afraid that he goes to Washington with a pen and will start vetoing, all their spending programs that are for their brother and their mistresses. Why did you have 80 military guys come out and said, "Oh, Trump's dangerous for the economy"? Why? Simply because he stood up and said, "No more nation building. We don't get anywhere with it." He's right. Vietnam, Iraq, Afghanistan, what do we get out of it? I lost half of my friends in high school to Vietnam. All right, for what? Strip joints and pole dancing? I mean, so then when you start looking at these things, I mean, it's just ridiculous. So what he has actually said in his ethical reforms, campaign reform, term limits, this is essential. All right, we're not going to fix anything without that. But and look, he's got the courage to stand up and say it. Will they rig the election? I think absolutely. And if you want to hear something really, and I sound off the wall on a conspiracy theory, but I've been in discussions with people in Washington. They do not want to have Trump take office. And if this is why they are planning stories in the press, Russia's going to rig the elections. So if Trump wins, they're going to basically deny it and say that it was rigged by Putin. That then gives them the opportunity to do one or two things. The most extreme position is Obama declares it like martial law and doesn't leave office, but then he hands it to Joe Biden. And say, okay, we have to be fair, so we're not going to give it to either one, because they don't like Hillary either. So that's the most extreme position. The second position is the popular vote does not actually elect the president. The electors go to the Electoral College. They have a pledge to vote according to what the people say. But there's no law that says they have to. It's not constitutionally required, and there's no statutory law. So they, too, at the Electoral College could say, oh, it's really a rigged election. Putin did all this, and so that was it. On Friday, there was a massive cyber attack. I haven't really paid attention to the news, so I don't know if it was really reported or not. But there was a cyber attack on the hubs of the Internet on the East Coast. So it took down Amazon, Netflix, Twitter, things of this nature. To do that, it had to be a massive attack. So this is not some 18-year-old in his bedroom. But as you know, I've been a computer science and engineer from the beginning. The only way, what they can easily do is they bounce the signals around. So they can go to Japan, then from Japan to China, from China they can go off to Ecuador, from Ecuador they can go off to someplace else. Put about 20 of these in there, and then the last one is Russia, and then Russia over to the United States to take out the hubs. Then they say, oh, see, it traced to Russia. That's just the last leg. That's it. Okay? And they can use that as a false flag to start wars or do whatever they want. So I seriously doubt that Hillary would win legitimately. And if you look at her disapproval rating. It's really astonishing. 65% of Americans think she's dishonest. The highest that any president ever got of the popular vote was 61. She beat everybody with her disapproval ratings. And the other curious factor is, yes, she has raised about 5 times the amount of money than Trump has, but they're all from the bankers. It's all the inside lobbyists. Who has raised the most money from individuals? It's Trump. He beats her by 3 or 4 million. So I think the computer's right, but I think they're going to rig it. And from what I hear in Washington, there's no possible way they're going to allow Trump to take the White House, regardless of what the people vote for. It's just not going to happen.
Always fascinating with Martin Armstrong, which you can find at armstrongeconomics.com. He has a free blog. You can get all sorts of great information there. But I'm going to take a break. I'll come back. I'm going to get right to the bond market, right to gold, right to U.S. stocks, right to the U.S. dollar. All of that coming your way on the Money Talks Network. Martin Armstrong, my guest. ArmstrongEconomics.com. Only got a minute or so before we have to break, and then I'll get more Marty after the break here. But let's start very quickly, Marty, if you can just give us the 1.5 minute sum up. Looking at the bonds, 5,000-year low in interest rates. Is there any sign that 30-year bull market in bonds is over?
Yes, it looks as though we're going to start seeing the movement, particularly from, I think this year is the low in rates, high in bonds. I mean, like I said on Friday, Greece came out and said, look, they have to restructure their debt again. I mean, everything is pretty bad as far as that is concerned. The money in Germany went into the 10-year bonds, but, and they drove it to negative yields, but that was really just a bet against the euro.
So we're looking at sort of a top forming in the bond market at this point, low in interest rates on that. When we come back, I'll ask Marty specifically about gold. Had a nice run up, but we think that's the start of a big move. What about the U.S. stocks? No progress this year, but what's to come? All of that coming your way right here on the Money Talks Network with the great Martin Armstrong, ArmstrongEconomics.com. Coming up, I've got a goofy award and a shocking stat, but right now I've got Martin Armstrong on the line with me. He's the subject, by the way, of a documentary, a good documentary, very entertaining, but very informative, called The Forecaster, which you can get. Just simply go to YouTube and type in The Forecaster, and you can get a look at it. It's great. Also, the subject of an upcoming Hollywood movie. It's in the works right now, but he's here with us on Money Talks. Started off with some big caution in the bond market, but Marty, we got a lot of people listening today who wonder about that run-up in gold, a nice run-up into about the 1360 range or so, down, correcting down to about 1240 and sort of hovering around there for a while now. Do you think that run-up into the 1360 was the beginning of a big move?
No, not yet. Gold still has the risk of moving back down. I mean, things have changed to some degree. I mean, look, 20 years ago, you could put, fill a briefcase full of gold and hop on a plane and go to another land and start over. You can't get on a plane with gold today. They've been largely hunting money every which possible way they can. All the gold, I have known people that were involved in refining gold. 2 of my friends for a long time that were in the industry, they just retired. They said, forget it. Because they had to report every ounce that came in, who it came from, and where it went. It was just ridiculous. So gold is probably more of a thing that you would not be able to necessarily travel with. But we're talking about gold does not respond to inflation. Well, these scenarios are just nonsense. I mean, the national debt went from $1 trillion to $6 trillion from 1980 into 2000. And then what happened? Gold went down for 19 years. So, we're not talking about a 1-year fluke. We're talking about 19 years of a decline. So those things do not match up. What does gold respond to? It responds to when people lose confidence in government, when you don't trust what's going on. That's also what, to a large extent, deflation is. Yeah, and people don't understand this. Why don't we have, they've increased the money supply, et cetera. But inflation is not the money supply. Inflation is when people no longer trust the money, so then they want to basically just spend it. Deflation right now, people are hoarding cash and they're not spending it. So it's you have all kinds of stories. They're selling more safes in Europe, etc. Switzerland's had to print more 1,000 franc notes. People are just taking their money out of the bank. They don't know what the banks are doing, and they're hoarding cash everywhere. So now when I travel, I'll tell you, I'll give you a tip. I think an up-and-coming business will be to rent a wife and kids to travel with. Because when I travel by myself, I get pulled over. You, come here. How much money do you have on you? It used to be, if you were traveling for business, yeah, go ahead. They were looking for the trinkets, the T-shirts, and everything else that they could tax you on. Now it's like, oh yeah, we don't care about the trinkets. How much money you got? And it's just really flipped all around. So we're in this deflationary atmosphere. Eventually, it will flip. All right, but what will happen is that flip will come. Probably will start most likely next year, because I've been saying we have this political year from hell. The first one was Brit exit. The second one is the U.S. elections. Next is the French, and then the German. We are looking at basically turning whatever you thought the future was completely upside down and shaking it. So your expectation of what's going to happen 5 years from now, nobody's willing to even bet anymore. So when that happens, you don't really want long-term debt. People contract, and they start saving money because they don't have confidence in the future. That's what deflation is.
So if we have that flip then coming up, as you say, it might be next year, year after, then you'll see, gold will start getting a bigger shine than the current move at this point.
Yeah, gold will be the hedge against, not inflation, it's a hedge against government. All right, we have the structure of the euro is an absolute nightmare. It's a disaster. The European banks' unperforming loans are vastly greater than anything in North America. And look at it this way. If the U.S. banking system allowed banks to have a reserve and there was no federal debt and they could use the debt of all 50 states, it would be a nightmare. If California went bust, then you're going to say, oh, well, which bank has the most California debt? This is what Europe is. There was no federal debt. To be politically correct, they had to have a piece of everybody. Then Greece goes down. Then Spain goes down. You have Portugal problems, Italy problems. No wonder the banks are losing money. And there's no confidence in the banking system. So this sends more and more capital over here to the States. And it's been difficult, but it's kept the U.S. looking as though the economy's all right. All right, but most of it's foreign capital inflows. So it's a different situation, and this is gold will take off as soon as people, I think largely then they wake up and they go, wait a minute, what is going on with the politicians? As soon as you lose the confidence in the politicians, then it flips. Hillary can say, oh, I'm going to help the middle class. She's never helped the middle class. And if you want to help the middle class, cut their taxes. How are you going to help the middle class by saying, oh, she's going to firm up Social Security and raise all the taxes to pay into Social Security? People buy and sell based upon what's left on the table.
Let me switch very quickly here because I don't want to run out of time. money coming into the U.S., that's what's the propping up the U.S. dollar. But what about U.S. stocks? No, it hasn't had a lot of progress over the last year.
No, but it's, you've had probably 9 out of 10 people, if not more, keep calling about the crash that never happens. Why? Because you have historical participation from the retail market is at record lows. So how can there be a bubble? All right. The money that is in the market is basically institutional at this stage in the game, and it hasn't advanced a lot, and it hasn't declined. It's coiling, and it's coiling because people don't know what to do. They're waiting for the election, then you're going to see a blip. All right. January seems to be the big turning point in a lot of this stuff. And when you realize that governments are in trouble, and you can't really, the big money can't really go into gold because it doesn't pay a dividend. They can buy gold stocks, but they can't, institutional money can't park in gold because, the guy who's giving the money, okay, well, what do you mean you made nothing this quarter? You can't report capital gains. You have to have some sort of dividend income. So they can buy the stocks, but, they don't buy the physical gold. What they do is they tend to flip and put money into the equities. And a few people have, said, "Oh, gee, you're wrong. The stock market's at record highs in PE ratio." It's nowhere near a record high. 23, 25 is nothing. The dot-com bubble was 50 to 1. But if you want to really look, what is the historical high? It was 120 to 1. When did that happen? 2009. It wasn't that they thought the stock market was going up. It's when you get to a point and you distrust the banks, you distrust government, what do? Here, I'll put my money in the best stocks. At least if I break even, I'm happy. That's what it's all about.
Martin Armstrong, my guest. Marty, sorry, go ahead.
So I'm just saying, the money, when it's going to come time to park, it's going to equities. You can't go into the bond market. We're at historical 5,000-year lows in interest rates, and we got sovereign debt crisis. Where are you going to go? Equities. That's the only place left.
Martin Armstrong, my guest. Marty, thank you so much for finding time for us. I've kept you a little longer than I promised, but it's always a real treat to hear your insights and what the model is saying on the various markets.
Well, it's always a pleasure to meet with you, Mike.
Great stuff. Martin Armstrong here. Go to ArmstrongEconomics.com. ArmstrongEconomics.com. You can just go on, just click on, you've got a little blog sign there. It's absolutely free. Tremendous background in a very unique way with Marty Armstrong. I've got to take a break. I'll come back on the Money Talks Network with the shocking stat, goofy, and live from the trading desk. Stay with us. The one thing for sure is we're living in these very interesting times. The chaotic times is a more apropos thing. The level of volatility is at historical highs. And what Martin Armstrong's just described is it comes out of the money moving around the globe and money moving out of Europe because its state is relatively worse than the U.S. That'll propel the U.S. stock market, eventually spill over into the world of gold. And as I say, interest rates are interesting to hear him say that he thinks that what we're seeing here is sort of the lows in interest rates, the top in the bond market, because that's major money that will move out of there and search for higher rates of return if confidence leads that bond market. You just heard, as he said on Friday, Greece says they can no longer afford their debt, and this is after the restructuring and after the bailout, so there's going to be more on that front coming up. And again, as I say, we've been very fortunate to have Marty with us at the World Outlook Conference all these years, and the model's accuracy, as he'd be the first to say, it's not him. His model's accuracy has been